Could the S&P 500 really be on the brink of a crash? That's not just speculation. There are serious indicators that suggest we might be staring down the barrel of significant economic turmoil. But why now? And what should you be watching for? Let's unpack the signs together and explore what this means for your investments. First off, let's talk about inflation. It's been relentless, hasn't it? Prices are soaring everywhere, from groceries to gas. And that's not just annoying, it has real implications. Central banks are scrambling to hike interest rates, and when that happens, the stock market doesn't usually smile back. Now, consider the debt. U.S. national debt has hit staggering levels, creating an undercurrent of financial instability. Pair that with geopolitical tensions, like the ones brewing internationally right now, and we've got a potential recipe for disaster. And then there's consumer confidence. People are hesitant, spending less. In economic terms, when consumer confidence wanes, historically, it means tougher times ahead for stocks. Remember 2008? The old warning signs are blinking again, only this time, they're backlit by even more global uncertainty. Stay with me here. What does this mean for the average investor like you? When consumer confidence starts to tremble, it's not just numbers on a chart. It's an indicator that folks are tightening their belts. Less spending leads to less revenue for companies, which can dampen stock prices even more. This reluctance stems from a fear of what's ahead, and with good reason. The domino effects of low confidence can start toppling quickly. Now, let's pivot to technology stocks. They've been the darlings of the stock market for years, pushing the S&P 500 to new heights. But is this tech bubble about to burst? Ever see a balloon stretched almost to its breaking point? Valuations for some companies are mind-bogglingly high, and as interest rates climb, borrowing costs rise. That's a big red flag for any industry fueled by easy credit and high expectations. Shifting our focus to global trade tensions, these have never really simmered down. Any hint of tariffs or sanctions can send shockwaves through supply chains, affecting businesses coast to coast. Remember, economies are more interconnected than ever, meaning a ripple somewhere can quickly become a tidal wave everywhere. So, what should you, a savvy investor, be considering amidst this chaos? Is it time to adjust your strategy? Stay informed, stay vigilant, and ensure your financial strategies are resilient enough to weather this possible storm. Being a savvy investor means not just watching the markets, but understanding the nuances behind these big shifts. Let's talk strategy. Diversification might sound like financial jargon, but it's incredibly important right now. Spreading investments across various sectors can help reduce risks. Think of it like this: don't put all your eggs in one basket, and that especially applies in volatile times like these. Next, focus on defensive stocks. Companies in essential sectors like utilities and healthcare tend to be more stable when turbulence hits. They provide products and services people can't live without, ensuring a relatively constant demand. Another potential lifeline could be precious metals. Gold, in particular, has a history of shining during economic uncertainty. It's not just a pretty metal. Consider it a hedge against inflation and a security blanket against widespread financial panic. Let's not forget the importance of staying up to date. In this digital age, information is power. Use tools and apps to track your holdings, read credible financial news, and perhaps consult with a financial advisor. The goal is to remain adaptable, because in this economic climate, being proactive can make all the difference. By analyzing these strategic moves, you're not just preparing for a potential storm, you're ensuring that you're in the best position to protect and grow your financial future. Let's dive deeper into the idea of being proactive. For many investors, there's a sense of dread that settles in when market forecasts turn grim. But remember, panic won't serve you. Instead, turn that energy into constructive action. Reassess your portfolio regularly to make sure it aligns with your financial goals and risk tolerance. Ask yourself, what am I prepared to lose? And where do I see growth opportunities? Consider keeping a part of your portfolio liquid. In times of uncertainty, having cash on hand can be a major advantage. It gives you the flexibility to buy undervalued stocks when prices drop, or to shift gears without being tied down. Liquidity can provide a cushion, giving you the freedom to pivot quickly as market conditions evolve. Also, embrace the power of patience. Emotional decisions often lead to regret. Don't let fear dictate your financial moves. Historically, markets go through cycles. Ups and downs are part of the journey. Steady, informed investing over time usually outperforms reactionary trades. Engage with communities, forums, and groups where insights are shared freely. Having a supportive network can provide new perspectives. Understanding that you're not alone in navigating these turbulent waters can be incredibly reassuring and empowering. Keep learning, keep questioning, and above all else, stay calm. So, how do we maintain calm amidst all this chaos? It starts with building a mindset that views challenges as opportunities for growth rather than calamities. Every downturn historically has paved the way for innovation and rebound. Some of the most successful companies today were born or thrived by innovating during tough times. This could be your moment to identify and invest in those under-the-radar opportunities that emerge as game changers. Now, let's focus on learning and adaptation. The market loves efficiency, and today's technology offers tools that make learning about stocks, bonds, and market trends more accessible than ever. Consider online courses or webinars to deepen your knowledge. Educating yourself continually not only gives you confidence, but also sharpens your ability to make sound, informed decisions. Networking with fellow investors also plays a crucial role. They might point you towards strategies or sectors you haven't considered, opening doors to new possibilities. Sometimes a simple conversation can drastically alter your perspective or offer a fresh insight. Finally, stay grounded by revisiting your original financial goals. Those goals were set with intent and foresight, serving as a steadfast guide through volatile market movements. By recalibrating using these goals, you ensure all your actions are purposeful and aligned with your big picture vision. The key is strategic action, rooted in knowledge and resilience. As you navigate this uncertain financial landscape, remember that knowledge and preparedness are your greatest assets. With the right information, strategies, and mindset, you can face whatever the market throws at you with confidence. So, assess your investments, stay informed, and be ready to adapt. Here's what you can do right now. Subscribe to our channel for more insights and updates on market trends and strategies. By staying connected, you'll be better prepared to handle market shifts and make informed decisions. Let's build a smarter, more resilient investing community together. Take control, stay curious, and keep charting your path to financial success.